How can investors ride out an economic slowdown, as well as some of the best recession-proof investments? There is likely no such thing as an entirely recession-proof investment, but there are some stock selection and investing strategies that typically turn out to work well in recessions. Stocks that have decent dividend yields and a high dividend coverage ratio can be highly effective recession-proof investments. A good recession-proof investment strategy is to seek out companies that are maintaining healthy balance sheets or stable business models, despite the economic drag. When comparing dividend stocks, some experts say that the best way is to look at companies that have a low debt-to-equity ratio and a solid balance sheet. A better recession strategy is investing in well-managed companies with low debt, strong cash flows, and solid balance sheets. Investors looking to survive and prosper in the downturn will invest in quality companies that have strong balance sheets, low debt, good cash flow, and are in industries that historically perform well in difficult economic times. Because investing during a recession involves moving into assets that are lower risk, these companies will generally perform better. Investors looking for an investment strategy in times of a downturn in the markets will typically add shares from some of these recession-proof industries to their portfolios. Because nobody can predict what the markets will do or how people will respond to the downturn, it is smart to stick with your investment strategy through a downturn to allow yourself to be part of the recovery. In the short run, with a higher chance of recession, you will want to shift some portion of your portfolio to recession-proof investments. If you invest in market low points in the middle of a recession, you are likely to be fairly successful over time. Investing during a recession can be a tricky experience, as markets can be very volatile, and you are probably trying to avoid any short-term losses. Investing during a recession can be much easier and even profitable, with a well-diversified portfolio and some tactical tweaks. Investing efficiently during a recession can lead to smaller losses, leaving you more capital to reinvest in lower prices. In short, recessions can be great times to purchase shares in high-quality businesses at favorable prices. The steep drop in share prices that occurs in times of crisis or economic downturn may provide a great investment opportunity. It is not uncommon to see stock markets drop, providing opportunities to invest in or buy shares in good companies at discounted prices. The market is going to rise, and over time, we are going to see dips, but at times such as these, the market is selling. This might seem counterintuitive, but a down market is actually one of the best times to invest, as we typically see asset prices fall. No one knows when the market will bottom out, so invest in stocks or funds that you intend to hold for years, even if the market continues to decline in the short run. If you are financially well positioned, have a long time horizon, the amount of time you have for your investments, and a high risk tolerance, you might feel like continuing to invest through the downturn. If you choose to invest, regardless of whether or not you are during a crisis or recession, there are ways you can attempt to reduce risk. During a crisis or recession, you might want to avoid investing in companies or industries known for being cyclical, speculative, or risky, like startups, hospitality services, and manufacturers, retailers, of luxury consumer goods. Key takeaways in times of economic downturn: most investors should avoid investing in companies that are highly levered, cyclical, or speculative, because companies with large levers are at their greatest risk for poor performance in difficult economic times. Speculative stocks typically drop the fastest during recessions, as investors withdraw money from the markets and scramble to secure investments that limit their exposure to tumultuous markets. During a down market, certain companies may be in position to keep making you money despite volatility. Stocks paying a cash dividend could offer an income stream, which can help compensate for some of the losses the market has caused to your portfolio. High-quality dividend stocks generally fluctuate less than other types of stocks, growth stocks, for instance, meaning that your portfolio fluctuates less. Plus, they may offer cash dividends, which will make sure you have some income when you are waiting for the markets to turn. While investors are scared about downturns, they also may make some of the best buying opportunities. A global crisis or an economic downturn may mean increased uncertainty and volatility in the investment markets. Even when recessions are on the horizon, nobody knows how long they will last or to what extent they will impact the stock market. With the projected Bank of England-backed forecast for a protracted downturn following a 0.2% decline in the British economy during Q3 this year, investors might wonder how well they could have made recession-proof investments. With inflation rising, stock markets falling, and the gross domestic product, GDP, dipping into the red, experts are debating whether or not the US has entered a recession. If you are looking to partially insulate yourself in the event of a downturn by using stocks, consider investing in healthcare, utilities, and the consumer goods industry. That is, if you have the cash to invest, you might consider buying into recession-proof sectors like consumer staples, utilities, and healthcare. Investing in bonds, dividend-paying companies, and diversifying your portfolio are wise decisions in an economic downturn. You can be prepared for the next recession by watching your money carefully, increasing your income and cash reserves, and investing gradually and steadily. As you grow your cash reserves, investing more in assets, things that appreciate in value, such as stocks or real estate, will reap the benefits over the long run. Also, in recessions, those who have access to cash are better placed to capitalize on investment opportunities, which can greatly improve their finances over the long run. In addition to increasing your retirement contributions, recessions are also great times to utilize various investing strategies. In the last section, we mentioned index funds, which can be an excellent way to invest in or out of a recession. Stocks such as Walmart Inc., McDonald's Corp., Procter & Gamble Company, and Johnson & Johnson, J&J, are some examples of stocks that have done well in the downturn. Meanwhile, growth stocks, which are stocks from companies expected to grow at rates higher than the broader market, do not generally perform well during a downturn.